Friends, in this video, I'm going to talk to you on the topic chasing returns at all times. Investment conversations happen at different levels. When you are talking to a friend, you are discussing ideas. But when you talk to an advisor, you actually straight away go to the level of discussing returns. But having worn the hat of an investor far longer than I have worn the hat of an advisor or a manager, I am always intrigued by one thing. An investor wants to get better returns, there is no doubt about it, but he also knows that there is a time when he should not chase returns. So, he tells himself that now I should be careful, so I should not worry about returns. This is how an investor is trained to think. When an investor goes to an advisor, he fails to do this. Instead, at all times, he is only discussing returns. So, he wants to always discuss returns and believes that discussion will lead to better returns. While doing so, he at times, and very critically so, fails to appreciate the time when he should not be chasing returns. So, even if the advisor wants to put that idea before him, the investor tends to resist this discussion and says, returns are low, that is why you are saying this. The reason is actually that you played safe and therefore you didn't get better returns in a volatile market. Is this something which an investor should grudge or regret? As an investor, I won't regret it because I know that there will be another market situation which allows my style of investing to prosper. So, if perchance I was more conservative than necessary as an investor, and as a result of that, my returns are looking lower for a brief period of time. When I say brief, it could be 1 or 2 years also. I would still have an opportunity to correct that when the opportunities in the market are more favorable and I feel more confident to take risks and see visibility of returns. So, when you choose to take higher risks is something an investor knows or should know, and if he doesn't know, he must let his advisor decide. Investor can't decide the risk level and then ask the advisor to perform or deliver to his perception. Usually it doesn't work because the investor may not know when to do that and he is purely driven by what he sees as market numbers. I've seen this peculiar situation where the market runs up because of 2-3 stocks. It could be Reliance, it could be Adani, it could be Bajaj Finance type of companies, it could be FMCG, it could be a small subset. Every bull market has been driven by not more than 10 stocks at the index level. Often it will be 5-6. So, in that bull market, if you are not owning those stocks and you are playing in the small cap or mid cap segment, for some time you will not perform. As an investor, it never bothered us. But when I donned the role of an advisor, my investor was very bothered. It's something which I always had to deal with. And I dealt with it. But I still feel that if my investor had a better sense of that subject, he could have probably done better. Many people say this when they talk to advisors and investment managers. I gave you money. Nothing can be more misleading than that statement because an investor in an RIA relationship or an investor in a PMS relationship or an investor in a mutual fund gives money to his investment portfolio. He is not giving money to the advisor or the manager. The advisor or manager probably may alert them to opportunity, saying that now you can give more money to your portfolio. At that time, the investor is not giving money to the advisor or the manager, he is giving money to his portfolio. I find that people who chase returns all the time fail to understand this basic truth. So, however much they chase returns, they end up chasing returns at the wrong time and avoiding the opportunity at the right time. As a result of which, what they want seems to be out of reach. Naturally, this affects the investor, it affects the advisor or manager as well, because the reason for which people come together, when not fulfilled, leaves a very bad situation. We all know that. But one must understand how to avoid this bad situation, and I think the best way to avoid the bad situation is not to chase returns at all times. Take a pause or a break from chasing returns when the risk reward is not in favor. Accept lower returns when your advisor or manager tells you to do so, and then keep your powder dry and your mind frame ready to take risks when you are alerted to do so. This will definitely improve the return performance, it will improve the investment experience, and it will definitely improve the belief of the investor in that advisor or manager or the asset class or all of them put together. Sales talk will always tell you where the returns are very high in the recent times. This usually happens in banking relationships. Your bank RM would always tell you that this is the best performing product, I want you to buy this. So the person chasing the returns will easily buy it, like people bought Nasdaq last year and bought tech funds in the early part of this year. All of these have happened, and it's very easy to sell a product to you based on past performance because you are willing to chase it. If you decide that you are not going to chase it, then nobody can missell to you and you will buy right. Not being missold a product is only part of what you need to be sure of. You also need to be sure of buying the right product at the right time. So, when you chase returns, the risks of being missold a product goes up exponentially or significantly, and the probability of buying the right product goes down. I feel every investor must avoid this situation and understand when he should chase returns and when he definitely should not. He must have an advisory relationship or a management relationship with the portfolio manager in such a way that both of them understand this, they are on the same page and they hunt for opportunities when valuations are in favor. If this is successfully established, then that relationship will be a winning relationship. The investor's relationship with the asset class itself will be a winning one. That is what makes your investing in equity as an asset class meaningful and productive. Thank you for watching this video.